CAPM, or in full form Capital Asset Pricing Model, is a model that describes the relationship between the expected return and the risk of investing in a security. It shows that the expected return on a security is equal to the risk-free returns plus a risk premium, which is based on the beta of that security. Here's an illustration of the CAPM concept. In a space where expected return is on vertical axis and market risk on horizontal axis, we have the security market line that tells for any level of risk what the fair value expected return on a security should be according to CAPM model. CAPM is calculated according to the following formula. RA is equal to RRF plus BA into RM minus RRF, where RA is expected return on a security, RRF is risk-free rate, BA is beta of the security, RM is expected return of the market. Note: RM minus RRF is the risk premium. The CAPM formula is used for calculating the expected return of an asset. It is based on the idea of systematic risk, otherwise known as non-diversifiable risk, that investors need to be compensated for in the form of a risk premium. A risk premium is a rate of return greater than the risk-free rate. When investing, investors desire a higher risk premium when taking on more risky investments.
Capital Asset Pricing Model Calculation. Formula for Capital Asset Pricing Model is expected return is equal to risk-free rate plus beta into market risk premium. Let us understand with the help of an example. An investor is considering buying stocks priced at Rs 367, which offer annual returns of 4%. Assuming that a beta factor of 1.1 is associated with this particular stock, one can calculate the expected dividend earnings by considering the risk-free premium as 3% and investor expectation of market appreciation by 7% annually. Putting the values in the formula, expected return would be 4% plus 1.1 into 7% minus 3%, then actual expected return would be 8.4%.
Expected return. The expected return is the profit or loss that an investor anticipates on an investment that has known historical rates of return. Point 1. The expected return is the amount of profit or loss an investor can anticipate receiving on an investment. Point 2. An expected return is calculated by multiplying potential outcomes by the odds of them occurring and then totaling these results. Expected returns cannot be guaranteed. The expected return for a portfolio containing multiple investments is the weighted average of the expected return of each of the investments. The expected return is a tool used to determine whether an investment has a positive or negative average net outcome. Risk-free return. It represents the interest an investor would expect from an absolutely risk-free investment over a specified period of time. To calculate risk-free rate, subtract the inflation rate from the yield of the treasury bond matching your investment duration. Beta, noted as BA in the CAPM formula, is a measure of a stock's risk, volatility of returns, reflected by measuring the fluctuation of its price changes relative to the overall market. In other words, it is the stock's sensitivity to market risk. For instance, if a company's beta is equal to 1.5, the security has 150% of the volatility of the market average. However, if the beta is equal to 1, the expected return on a security is equal to the average market return, market risk premium. From the above components of CAPM, we can simplify the formula to reduce expected return of the market minus the risk-free rate to be simply the market risk premium. The market risk premium represents the additional return over and above the risk-free rate, which is required to compensate investors for investing in a riskier asset class. Now let's discuss the importance of capital asset pricing model. Number 1. The capital asset pricing model is widely used in the finance industry. Number 2. Capital asset pricing model plays a vital role in calculating the weighted average cost of capital as capital asset pricing model computes the component of equity. Number 3. Capital asset pricing model is superior to other return models in providing discount rate to be used in investment appraisal. Now let's have a look on advantages of CAPM model. 1. Superior to weighted average cost of capital. 2. Theoretical derived relationship. 3. Better than dividend growth model. 4. Considers systematic risks. 5. Simple and easy to use. 6. Adjusts to business and financial risk variability. Here are some key takeaways that viewers should remember about the capital asset pricing model. It helps investors calculate the expected return on an investment based on its level of risk. While the CAPM has its limitations and has been criticized for its assumptions, it remains a useful tool for estimating expected returns and determining the appropriate level of compensation for risk in financial markets.